Seema, good to have you here as always. Walk me through what do you think is going to be important this afternoon from the FOMC.
Hi, good to be on. Look, compared to previous meetings, this is really going to be one of the least eventful meetings we've had for a long time. We would expect Powell to continue around the same tone that he's been taking, so acknowledging that there has been an improvement, but I don't think we're going to get any discussion of tapering just yet.
So no discussion of tapering just yet. What do you think the expectations are in terms of like the consensus view? Always kind of hard to know precisely, but if they don't talk tapering, is that expected? Is that a surprise? How do the expectations work into this?
So I think that the market is not anticipating anything just yet. They think it's a couple of more months before we do hear any news, or at least some kind of hinting that tapering is on the way. They need to see maybe some new economic forecasts which come out in June, and then at that point there may be some discussion. So really, unless Powell springs a major surprise on markets today in terms of the content of his press conference, I wouldn't really expect any major market reaction.
Okay, no major market reaction. We're talking mostly bonds here. Seema, walk me through how you're thinking about treasuries as what does drive them, given we've seen lower yields over the past month. But as we've been talking here this morning, they're starting to wake up a little bit. We've seen some more push to the upside these past few days.
Yeah, when we look at the rise in yields over the last 3 months in aggregate, look, it makes sense, right? We've seen considerable upgrades to economic growth forecasts for the US. We've seen, the reflation openings. We've seen the fiscal support packages. So it all makes sense. And I think importantly from the Fed's perspective, the rise in yields still hasn't fed into a tightening in financial conditions. So this is all very much consistent with the economic progress that we've been made. Plus, it's not really weighing on the economy. So from their perspective, I don't think there's too much to worry about. And of course, they will be keeping an eye on it. But I think with yields where they are today, I don't think this is going to be a major concern for them.
We've also got news building of the next round of stimulus. Maybe some more strings attached, though, than the last few, as we're talking tax hikes and more. How does that factor into this discussion of how the bond market responds to the recovery that is organic as we now get back to normal, but also has that additional stimulus coming from more government spending?
Yeah, it's interesting. Look, I think the market has, overall been surprised by how much the Biden administration is planning to do from a fiscal front. But importantly, look, this latest one, it's going to be fully offset by tax hikes. It's also something which will be playing out over a number of years. So it's a very, very different impact on the economy as of, in the near term compared to what you're seeing from the American Rescue Plan. Importantly, maybe if it wasn't going to be offset by tax hikes, we'd see additional concerns from an inflation perspective. So I think this is something that the market is just waiting to see how it unfolds. What will it eventually end up at? What kind of tax rates are we talking about? And then maybe at that point, we could see some additional movements, but I would think that'd be mainly from the equity market side.
So we've got more stimulus coming here in some form, maybe some caveats this time. But in the meantime, demand already picking up. We've been watching agricultural prices just go through the roof. Is that market telling us anything about inflation potential or risk that we didn't have a couple weeks ago before corn and soybeans and a lot of these input agricultural commodities just went rocketing higher?
Yeah, I think, look, clearly this is a concern because food price rises of the size that we're seeing will have an actual impact on American households. But I think from the Fed's perspective, this is also all part of what they're anticipating. We heard from Powell that they are expecting a rise in inflation, but they're anticipating it to be transitory, mainly down to base effects and mainly down to supply side constraints as the economy reopens and you get that. So commodity prices have been rising. We need to keep that in mind. But I think from the Fed's perspective, they're very much tied to the idea that unless inflation is above that 2% point for a persistent period, which at the moment, at least from their minds, that's not what they see, it shouldn't be enough to disrupt the interest rate path that they've put themselves on.
When we talk about transitory, this is kind of the mystery of what that definition is going to be. It would seem to me that the bigger impulse we're getting right now than the longer potential for inflation or sustainability of that inflation it could be, where if the average economist estimate is for 6% GDP, but we start seeing more along the lines of 7 or 7.5 or 8 possibly. If we do start getting numbers now that are bigger, should that make us think about the potential for inflation is longer lasting? And do we need to get clarity from the Fed at some point on what qualifies as transitory? Like, is it a year? Is it a couple of years? Is it a couple quarters?
Yeah, look, I think these are all important points. And, I think when we look across all market participants, everyone's got a forecast of inflation, but I don't think anyone has full confidence in that outlook. At the moment, it certainly seems like it's transitory because it's mainly driven by areas which would typically fade out once you get supply moving. But that's not to say that, look, as you said, if you do get economic growth being considerably higher than where it is already forecast to be, 6% is already very high. If you're looking at considerably higher numbers, then you're thinking that labor market slack is going to be eroded more rapidly. You get earlier wage hikes. And then that would be maybe passed on to consumers. So, these are all things that we need to keep an eye on. Undoubtedly, the Fed will be doing the same thing. And the one thing that we do expect is that as we see the actual inflation numbers start to rise through the summer months, you are going to see markets repeatedly grappling with this idea and wondering and worrying about how the Fed is going to respond. So this question of inflation is not going anywhere anytime soon. I suspect that by the end of this year, we'll still be having a conversation about inflation and what the Fed's response is going to be to that.
And right now, the overall conclusion from your team is, from an asset allocation standpoint, to generally be comfortable with risk assets. But even though there's not going to be any big changes to the Fed, it doesn't look like you want to own too many bonds from what I see in the notes.
Yeah, so generally we think this is certainly a risk-on environment. It's a very strong reflationary environment. And we know that we still have the Fed very, very supportive, at least for the next couple of years. From a fixed income perspective, look, it certainly is a lot more challenging environment than we've had in previous years. And maybe, the Treasury mortgages side, it's an area to keep an eye on. It's almost a tactical trade. So as we start to see rates move higher again, maybe at that point you want to be going slightly more neutral or overweight. But, this is a time, again, to look at high yield, look at investment grade, anything which has got a bit of credit in that perspective where you can get a little bit more additional yield. And of course, emerging markets. If you're looking at carry, this is where you're going to get it. But of course, you have to pick your area very wisely.